Today, the property cracks are widening. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today we're going to look at some of the recent research from a flurry of surveys across the property market. Combined, they paint a concerning picture. And we also look at the stamp duty question later in the show, so stay around for that. But first, some 26% of Australians see mortgage repayments as a significant cost of living concern. That means just over 5 million people may be worried about keeping up with mortgage repayments in the coming months. That's according to a survey conducted by online financial broker Savvy. Of the 25 to 34-year-olds and the 35 to 44-year-old groups, 38% said mortgage repayment rises are a significant concern when it comes to their ability to keep up with the cost of living. Other age groups expressed a lower level of concern about mortgage repayments, with 25% of 18 to 24s, 32% of 45 to 54s, 18% of 55 to 64s, and only 6% of those aged 65 and over. Survey findings showed that 43.86% of mortgage holders forked out between $251 and $500 on repayments each week, while 23% spend between $501 and $750, and a further 18% claimed to pay $751 or more per week to cover their mortgage. Now, about 8.1 million Australians were identified as having a mortgage in the survey, and if that 23% who said they have mortgage repayments between $500 and $750 a week were single-income households, they would be in real trouble, said the CEO of Savvy. The COVID mortgage holidays are over, and for some families, there may not be much left in the tank when it comes to covering mortgage repayments. The respondents also revealed their top 3 responses to mortgage repayment increases resulting from an interest rate rise. Some 53% said they would try to cut down on their other expenses to prioritise their mortgage. 28% said they would absorb the increase, and 26% said they would simply grit their teeth and experience mortgage stress. Meanwhile, 20% said they're prepared to change lenders or to refinance, and 13% would lock in a fixed rate with their current lender. And of course, as I've said before, if you can refinance to a lower rate, now is a great time to do it. There are still some good rates out there, but actually, if you look around, you may be able to get better than what you've got at the moment. And elsewhere, mortgage stress is still low as borrowers reap the benefits of low interest rates and government stimulus. But that is set to change soon as interest rates continue to rise, according to new research from Roy Morgan. Now, that research company found almost a fourth of mortgage holders were at risk of mortgage stress in the 3 months to March. That's translating to around 762,000 vulnerable borrowers with repayments greater than a certain percentage of their after-tax household income. Now, that, of course, is a catch. It's often used, this 30% rule, and it really doesn't tell the full story because, of course, households have many other expenses going up too. But nevertheless, Roy Morgan continues to use this rather outdated definition of mortgage stress. They did go on to say, though, that fortunately the 17.5% of borrowers at risk paled into comparison to the record high during the global financial crisis. And Roy Morgan noted the figure was less than half the rate at the height of the GFC, when 35.6% of mortgage holders were considered at risk on their definition. On the other hand, only 438,000 mortgage holders were considered extremely at risk, but this count was conducted months before the Reserve Bank of Australia went on their rate hike cycle, so the number will of course increase. The RBA increased interest rates for the first time in over a decade in early May to 0.35% and early June to 0.85%. That's the most significant increases since February 2000, and of course more are coming down the tubes. And Roy Morgan said incorporating the current interest rates in the March quarter would put 34,000 more mortgage holders at risk and 28,000 more at extreme risk. And it's expected the RBA will continue to increase interest rates in the months ahead as Australia faces its highest level of inflation in over 2 decades, they said. If the RBA increases interest rates by 0.5% at its July and August meetings, that will mean official interest rates will have increased by 1.75% since early May. And when the RBA pushes through with interest rate rises in the next 2 months, Roy Morgan said an additional 81,000 mortgage holders will be considered at risk, and the upward trend is expected to persist as more hikes come through in the second half of 2022. However, rising interest rates is only one of the many variables that can determine whether or not a mortgage holder becomes vulnerable. And Roy Morgan pointed to household income as having the most impact on a borrower's category of risk. These figures suggest that as long as employment levels remain strong, the number of mortgage holders considered at risk will not spike alarmingly over the next few months as interest rates are increased from the record low levels experienced during the last 2 years. The RBA's latest statement on monetary policy suggests inflation in Australia will peak at around 6% in the second half of this year, although of course more recently Lowe has talked about 7%. If this does happen and inflation pressures begin to reduce in the period after that, this will reduce the likelihood of further increases in interest rates later this year and into 2023. Well, we'll see. The latest news about the markets is they're talking about rates up to 4%. That means mortgage rates at 6%. And as I've said many, many times, you cannot look at just the percentage of income going on the mortgage. You've got to look at the total flow of cash out from the household, which is the way that I define mortgage stress. When I do that, the numbers are considerably worse. Now, what about those who bought property thanks to the bank of mum and dad? Well, new research has shown that while there's no stigma for millennials who seek help from the bank of mum and dad to get on the property ladder, they're also at the highest risk of losing their homes. Bank of mum and dad homeowners and lenders in 5 local government areas in New South Wales are feeling the pinch of higher mortgage rates already amid a cooling property market. According to property data provider National Property Group, the house prices that increased as much as 117% over the past few years are now plummeting in value. In 2021, the Bank of Mum and Dad became the country's 9th largest mortgage lender, according to our research, with around $34 billion of loans, as more parents provided financial assistance to help their adult children buy their first home. In fact, more than half of first home purchases in 2021 came from this market, but the situation couldn't be more different now. Experts warn that those who took advantage of the Bank of Mum and Dad are at a larger risk of defaulting on their mortgage within 5 years. Some of those Bank of Mum and Dad backed property hotspots include Blacktown and Ryde in Sydney and Queanbeyan, Albury and Coffs Harbour in regional New South Wales. Our data identifies key markets across metro and regional New South Wales where home values are starting to fall, which increases the risk of negative equity for some previous purchasers, said Don Harb, Chief Operating Officer at the National Property Group. The LGA of Ryde has seen a 16.8% fall in property values, and we're also seeing slight dips in home prices in regional LGAs, such as Queanbeyan. For Bank of Mum and Dad buyers and lenders, these trends could signal that it's time to assess their financial future. And Nigel Horn, the principal of Albury-based Nigel Horn Real Estate, is seeing firsthand how the pandemic, interest rate rises and demand have spurred a rise in regional property prices and the impact this is having on buyers. Throughout our dealings with buyers, family financial assistance to fund a deposit has been a factor, Horn said. Since the pandemic took effect in 2020, property values have increased significantly in our region. In my experience, demand has not slowed, and there is still a shortage of properties. And as the lack of inventory and the impact of increasing interest rates on borrowing power started to influence thinking, it was even more likely first home buyers would call upon the Bank of Mum and Dad for financial support. But Horn said younger buyers would also need to reconsider their purchasing criteria. For first home buyers, this might mean the style, age, or size of the property they purchase may now differ from what they could have bought before March 2020, he said. And what about property investors? Well, some 54% of property investors are concerned about a potential property market crash, but only 22% selected as their primary concern, according to new research by the Australian fintech startup Tax Tank. And the study also found that property price crash concerns are higher among younger investors, indicating that those who've been in the property market longer were potentially seeing the changes as part of the ebb and flow of investing, or even as an opportunity. With property values declining for the first time since 2020 amidst high inflation and rising interest rates, Tax Tank founder Nicole Kelly said she's seeing more property investors wavering between buying and selling. Some clients see this market change as a potential buying opportunity and are watching property prices closely for a decline. Kelly said it's a real balance between managing the investment properties they have and taking the opportunity to expand their portfolios. At the moment, many are sitting on the fence, waiting for the market to drop and to see how the next few months play out. And the study also found that only 34% of property investors know their cash position well, and only 21% know their tax position well, while 20% know little about their current equity position. Kelly highlighted the importance of knowing the overall equity of investments and understanding cash and tax positions in managing an investment portfolio, as well as in making decisions about buying and selling. From our study, we know solid rental returns are a major consideration in the decision-making process when buying, and rental demand is not likely to slow anytime soon, she said. Likewise, understanding the difference between the cash and tax position, which is amplified by rental returns and depreciation, is imperative when comparing property performance. This is particularly important when considering which property to sell. Knowing the available equity in each property and your portfolio as a whole ensures you never miss an opportunity. Couple this with growth forecasts based on 10-year monthly averages, and you have a powerful decision-making tool. Whether it's reduce tax or set yourself up for retirement, understanding why you're buying and holding investment property is paramount. So too is monitoring the performance of each property to ensure that they're working hard for you. And Kelly added that reducing tax requires negatively geared property, which is why it's crucial to know investors' tax position and how to maximize soft dollar expenses like depreciation. However, knowing how much cash you need to support each property is just as important, especially if you're planning to expand your portfolio and beef up your borrowing power, she said. And I'd make the point here that many property investors are substantially underwater now. In our analysis, around 60% of property investors are losing money, thanks to the rising interest rates and thanks to the lower real returns than many spruik. And I have to tell you that those with multiple properties in a property portfolio are now very much under the gun. One of the reasons why we see the highest levels of investor stress amongst our more affluent household groups. And that includes those who are the younger affluents as well as the exclusive professional groups. And given where we think property prices are going to move from this point and the future pressure on higher interest rates, it's no surprise to us that more property investors are now moving to sell their properties than to acquire new ones. Now, of course, the market will be spruiking the benefit of property investment even through the downturn. But I would say absolutely she's right in saying you need to know your position, you need to know your cash flow, and you need to make better decisions than most property investors do because they are myopically looking at the cash flows and financial positions of their investments. And just like any other investment, it's critical to get a holistic view before you start making decisions. Many property investors came in assuming that property prices would always rise and that this therefore was a lay-down misère. Like I say, 60% of property investors are currently underwater, and that's despite all the tax offsets. And now finally, stamp duty changes in New South Wales could help some first home buyers get into the market sooner, but its limited availability lacks the benefits of a broader overhaul, experts say. Stamp duty has long been disliked by economists as it's a tax on moving house. The New South Wales government had hoped to offer all buyers the choice between upfront stamp duty or a smaller annual land tax, making it easier for homeowners to upgrade to a bigger home, downsize to a smaller one, or move closer to a new job. But losing stamp duty revenue would be a short-term hit to the state budget, and so instead the government opted for a more modest change that allows only first home buyers to opt out of stamp duty. This was announced in its budget on Tuesday. Once someone owns their first home, they would still face stamp duty on their second, which discourages moving, Grattan Institute Economic Policy Programme Director Brendan Coates said. It looks less like a tax reform and more like just another support for first home buyers because it doesn't actually really start the transition, Coates said. The big economic costs of stamp duty are about whether you go and buy again and move again. That's the point at which people's housing choices are constrained because they don't want to pay stamp duty on the second property. But Coates said it would improve home ownership rates by reducing the deposit hurdle and help some people to buy a home sooner, although it would also marginally increase prices. And he said more substantial changes would have needed some financial support from the federal government. Domain figures show buyers who plan to move again in the medium term would save money by choosing land tax over stamp duty. For example, someone who bought a $1 million home could pay land tax for 16 years before equaling the amount they would have spent in stamp duty. And a buyer at $1.5 million would take 18 years. Barrenjoey's senior economist, Jonathan McMahon, labelled the plan reform-ish. It's definitely a more watered-down version, he said. By limiting it to the first home buyer group in particular, it makes it a weaker policy overall. And he said it would reduce the time to save a deposit on the median home by about 3 years and also enable some buyers to borrow more money, which could put upward pressure on prices for properties under the $1.5 million cap. This boost could also encourage some owners in this price bracket to sell, although he cautioned there would also be a dampening effect on property prices from rising interest rates. It's not going to bring the benefits that the initial policy would have had, which would have been to boost supply from those upgraders and downsizers, because now I can move, because I don't have to be faced with this tax on movement. He said the plan was a stepping stone to a larger reform that could help the public get used to the idea of land tax and put more pressure on the federal government to help with the transition. Independent economist Saul Eslake said the impact of the stamp duty change would be small, as so many first home buyers would be purchasing under the $800,000 threshold, which already offers a stamp duty concession or exemption. Any movement in that direction is progress, but it's a tiny step. A bigger step may have had a much bigger revenue cost than previously thought. He said buyers will quite rationally choose between stamp duty and land tax based on whichever option would allow them to pay the least amount of tax, which meant the revenue loss to New South Wales government would be greater. He suggested another model would be to switch broadly from stamp duty to land tax, but offer a credit for the amount of stamp duty people have paid in recent years, which would mean a smaller loss of government revenue. The federal government could not only offer financial assistance, but could also direct the Commonwealth Grants Commission not to reduce the GST revenue share of a state making the change, Eslake said. And New South Wales Property Services Commissioner John Minns told a panel discussion on Tuesday he would like to see the land tax change expanded to include the whole property market and not just first home buyers. Getting rid of stamp duty will help people to move, Minns said. Removing a tax on mobility, I'd love to see it succeed and move forward sooner rather than later. But just remember, such a move would primarily benefit property investors who could offset the annual tax cost against their income from the property, whereas owner-occupiers cannot. So in fact, if it was changed, it would have a twofold distorting effect. Firstly, it would lift the price of property by the stamp duty saving, and second, it would orientate the benefits towards investors. In fact, In short, this reform is not what it seems to be at all. It is primarily, I think, supporting the construction sector almost exclusively. But don't tell anybody, because of course the construction sector needs all the help it can get, doesn't it? Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.